Hello and welcome to this 11th lesson in financial accounting. So lesson 11 is basically the statement of cash flows. So this lesson is going to be split into two. There's where I'm just going to explain the concept of the statement of cash flows, which is this lesson. Then there's another part of this lesson which I'm going to explain how to prepare the statement of cash flows. Yeah. So let's begin. So the first thing that you need to understand, let me just get my pen here. So the first thing that you need to understand is what is a statement of cash flows. So when we are preparing financial statements, so there are I think four financial statements that you need to prepare. The statement of profit or loss, statement of financial position, then there's statement of cash flows, right? Then there's statement of changes in equity. Then there's also notes to financial statements. So in this lesson, we're going to focus more on the statement of cash flows. So what is a statement of cash flows? So statement of cash flows, this is a financial statement which provides information to users of financial statements about the entity's ability to generate cash or cash equivalents, as well as indicating the cash needs of the company. So now the statement of cash flows, right, it just provides further information. So remember, we already have statement of financial position, statement of profit or loss, we've got the statement of changes in equity, right? So now this statement of cash flows just complements those financial statements. So it tries to look at the liquidity of the company, just how much cash is the company having at the end of the period. Then it also tries to summarize the transactions, the cash inflows as well as cash outflows, right? Both cash and cash equivalents. So we're going to look at these cash equivalents in more details. But right now, what you need to understand is the statement of cash flows focuses on the liquidity of the company. How much money does the company have, right? How did money, cash, move within the business? How did money come into the business, and how did money leave the business? That's what the statement of cash flows simply looks at. So now let's look at the benefits of the statement of cash flows. Why is it beneficial preparing a statement of cash flows? So one, it allows users to have knowledge of the company's liquidity, right? So now remember, the statement of cash flows looks at how money has moved within the business, right? From the beginning of the period to the end of the period, and how much money the company has at the end of the period. So it focuses on the liquidity, and it allows the users to know just how liquid, how much cash does the company have. Then two, enhance comparability because they are not affected by differing policies for the same transactions. So remember, when you're comparing two companies, right? Let's say for instance we're using the statement of profit or loss. Statement of profit or loss is not as reliable. Why? Because different companies use different accounting policies, right? So I'll give an example for depreciation. So one company can be using straight line method, the other company can be using reducing balancing method. So when you're comparing the two, the comparison won't be as accurate because these two respective companies, they've got their own way of applying depreciation. But in the statement of cash flows is direct, straightforward. It's not affected by differing accounting policies and standards that are used by different companies. So statement of cash flows is straightforward. How much money came in the business, how much money left in the business, and how much money does the business have at the end of the period. So it's easy to compare the position and performance of the company. Then cash flows of historical nature can be used as an indicator for the amount, timing, and cash flows. So now, this statement of cash flows is based on a statement of profit or loss as well as a statement of financial position, right? And this information that's found in these two respective financial statements is historical in nature. So it it acts as an indicator of the amount, timing, and certainty of cash flows. So how much cash flows is coming into the business, how much cash flows is expected to be coming into the business in the future periods. So the historical information can be used as an indicator of how much money and the timing, as well as the certainty of cash flows, are going to come into the business. So now, this information that you have, right, it can also be used to check the accuracy of actual figures when they emerge. So what does this mean? So you've got past indicators. So you project just like how much cash flows you want to have in the future periods, right? How much money you want to have in the future periods. So now you can compare the past forecast as well as the statement of cash flows to see how much money you currently have and to see just how well the company is performing given the projections that were put in place. So now let's look at the key definitions that you need to understand when you are carrying out or you're preparing a statement of cash flows. So number one, cash. So cash comprises of cash and cash equivalents. So cash, the actual money, right? The actual money, that's cash. Then cash equivalents. So let me just come here. So cash and cash equivalents, right? What are cash and cash equivalents? So these are short-term, highly liquid investments that can be readily converted into cash and are subjected to insignificant risk, right? I think this is just supposed to be cash equivalents, not cash and cash equivalents. But anyway, we'll keep it like that for now. So let me just confirm. So cash and cash equivalents, right? These are short-term, highly liquid investments that can be readily converted into cash and are subjected to insignificant levels of changes in price. So for example, cash and cash equivalents can maybe include, say you have an investment, maybe say in treasury bills, right, and government bonds. So treasury bills and government bonds, you can sell them off, right, before their maturity. So if you want to sell them off, you can actually sell them off at any point in time where you feel you are lacking in finance. You can sell these instruments, right? So largely money market instruments, right? Money market instruments, these are the ones that are cash and cash equivalents. So they can be easily converted into cash, right? And they're subjected to insignificant levels of risk. Then cash flow. So inflows and outflows of cash and cash equivalents. So when you hear cash flows in the statement of cash flows, it just simply means the inflows and outflows of cash, how money is coming in and going out of the business. Okay, then operating activities, right? Remember, I think I haven't yet talked about this. We're going to talk about it in broader detail. So the statement of cash flows is classified into three. Like the three items that are expressly discussed in the statement of cash flows. There's operating activities, investing activities, as well as financing activities. So there's operating activities, investing activities, and financing activities. We're going to look at this when we go into detail on how to actually prepare the statement of cash flows. So now let's just define what operating activities are. So these are principal income generating activities of an entity and other activities which are not investing or financing activities. So in simple terms, operating activities, these are just activities which bring in money on a daily basis. So an example of an operating activities, let's say you sell, just give an example, you've got a shop and you sell mini meal. So mini meal is your primary stock, it's your primary inventory, right? So now the money that comes in from selling inventory, right, that's part of the operating activities, right? Whenever you sell inventory on credit and then you receive the money from the receivables, so the movement in receivables, that's operating activities. The movement in payables, you buy millimil on credit, all right, and then you sell it, right? So you owe the supplier. When you pay the supplier, there's a movement in payables. That's an example of operating activities. So operating activities is just basically activities which are carried out on a daily basis, right? These are activities that are the engine of the business, activities which generate income. These are income generating activities. Then investing activities, right? Investing activities. Why investing activities? Acquisition or disposal of non-current assets and other investments not included in cash equivalents. So now investment, the perfect example I can give for an investment activity. This is where you sell property, plant and equipment. This is where you buy property, plant and equipment. For instance, you buy a vehicle, you buy a house, you sell a house that is owned by the business. You buy maybe let me give another example where the companies with computers, you buy those computers, you sell those computers. Those are investing activities. If you've invested as a company, you've invested in treasury bills and you receive interest, right? That's an investing activity, right? So investing activities, these are just include acquisitions or disposal of non-current assets and other investments not included in cash and cash equivalents. Then financing activities. What are financing activities? Financing activities, these are activities that result in changes in size and composition of equity capital and borrowing of equity capital. So here, the perfect example is, let me give an example. So financing activities where you issue equity, you issue shares. So there's an increase in shares, all right? You contract debt. You get into a debt facility with the bank. The bank gives you some money. That's also falling part of the financing activities, right? So now, how do we prepare the statement of cash flows? So remember, the statement of cash flows has got three major components. So three major components. We've got operating activities, investing activities, financing activities. So operating activities, they relate to the day-to-day activities that determine profit or loss, right? So operating activities, they relate to the day-to-day activities that determine profit or loss. For example, receipts from customers, you make a sale, or purchase of inventory, you buy inventory from the supplier. Then investing activities relates to the cash inflows and outflows resulting from the company's investments. So you sell non-current assets, for instance, you receive interest, right? You buy a patent, that's an intangible asset, right? All those are included in investing activities, right? Then you've got financing activities. What are financing activities? These relate to the cash inflows and cash outflows resulting from raising capital and redemption of issued capital. So you issue capital, you issue new shares, that's included in financing activities. You pay off the debt that you have, that's included in financing activities. So you need to remember this. But if I give you the format, it's going to be easy. You won't really have to worry about it. So now, what are the advantages of the statement of cash flows or cash flow accounting? So this is some theory that you can be asked. This is something that you need to be easily able to understand or respond to the question. So survival of the business depends on its ability to generate cash flows, right? So now that's important. That's the major importance of cash flow accounting, because the survival of the business depends on its ability to generate cash flows, and that's the reason why we need cash flow accounting. Then point number 2, more comprehensive than profit, which depends on accounting principles. What does this mean? This means statement of cash flows is more reliable to assess the position and performance of the business. Why? Because it's not affected by accounting principles as well as concepts. So it's not affected by those non-cash transactions and deductions. That's why it is more comprehensive than profit. Then point number 3, it provides better means of comparing results or performance of different companies as opposed to traditional profit. Remember, I already explained this in the first slide, right? Profit is not reliable because it's subjected to accounting policies and concepts. For example, depreciation, right? It's one of the examples that may inflate or deflate the profit, right? So it's quite difficult to compare between two different companies. So now, if a company is using the statement of cash flows as a medium or means of comparing two different companies, it's going to be more reliable, right? Then the last point is statement of cash flows can be easily understood even by non-financial managers. So the statement of cash flows is straightforward and it's very easy to understand and comprehend. So even those who are not financial experts, they can be able to understand what this statement of cash flows is all about, right? With that said, the first part of our lesson has come to an end. Thank you very much.